There's actually a different angle also, which I look at, and I know you and I talked about this earlier. US products were very, very low. They have been building very
Very
rapidly,
fast.
particularly gasoline.
Yeah.
And from my perspective, again, just looking at different factors, that's one support which has weakened.
Welcome to The Energy Desk, a podcast from Mobius Risk Group. In this series, we break down the macro forces and fundamental trends shaping global energy markets, from geopolitics and policy to supply, demand, and price risk. Each episode is designed to cut through the noise and give you clear, actionable insight into what's driving today's energy landscape and what it means for what comes next. Follow the show wherever you get your podcasts. You can share your feedback or ask questions by emailing info@mobiusriskgroup.com.
Mohit, welcome back. Season 2, Energy Desk. And we're here in January 2026. How's it going?
Good. Thank you for inviting me back.
Well, you're now the main show. So I think we're going with this going forward. Plenty of exciting things going on for the first 9 days of 2026. I think obviously a good place to start the year is maybe just covering some of the macro and crude centric topics that we have, since that is definitely dominant. And then we'll have Drew back sometime soon to talk about the natural gas side of things.
Yeah, sounds great.
Yeah, so I think, maybe it'd be helpful just to kind of set the stage for the turn into the new year. For the crude market, obviously, the primary concerns for the fourth quarter of 2026 or 2025 rather were definitely the oversupply conditions or fears of oversupply. And so the debate was really just between the bulls saying, well, onshore inventories are quite low. We're not really seeing the builds that we are supposed to be seeing if we take the IEA or some of these other forecasters at their word. Towards the tail end of the fourth quarter, we started to see those builds in onshore inventories. Obviously, the U.S. would be the last one to do that in many ways. And so we started seeing U.S. onshore inventories build, lift off of the floors of the last decade. And then we turn into the new year, plenty of geopolitical risks from the Russia-Ukraine situation, emerging risks from U.S. pressure on Venezuela. And then Jan 2, Jan 3, we get the U.S. intervention in Venezuela. And Nicolas Maduro is captured and brought back to the U.S., leaving the former Maduro regime interim government, now headed by the interim president, Delcy Rodriguez. I think maybe with all of that, starting out with just your thoughts on the Venezuela move and I guess the lay of the land in the market, and maybe we can go from there.
From my perspective, I think the market is already very bearish in terms of where they thought supply demand is going to be. And when the Venezuelan news came out, I think a lot of people were expecting that there would be a gap lower. And this happened on the weekend, and everyone, including us, was ready, manning the desks. But it's a very technical term. It was a nothing burger. And I think I was not too surprised by it, because if you think about where speculative positioning is, length had already exited, a lot of it had already exited the market, and shorts were pretty close to extreme levels. So in my mind, it was who's left to sell. And having traded this market, a lot of people would look at it, okay, if it's not going to go down, then I don't want to be short. And that's kind of what we saw. There was a bit of a battle there. And when it didn't go anywhere, it just kind of hung out there. And then last 2-3 days, we've seen there's been some kind of short covering rally. And again, not driven by any news, a little bit about, hey, there's some Iran chatter, but it's ongoing. I mean, it's headlines which are trying to fit the price action. I think we'll talk about spec positioning again later. But the other thing which is interesting is where do those barrels go? And one of the main areas is the U.S. Gulf Coast. And so now you're going to have the Gulf Coast trying to get the barrels from Venezuela rather than from Canada, because it's a more advantaged barrel. So I think that's the real battle which is going to happen in the intermediate term.
Yeah.
Sorry, go ahead.
Yeah, no, I should say it was a very interesting one for us over the weekend, obviously discussing the nuance around Venezuela, because as you said, initial reaction could be bearish from that. But I think it's important to maybe discuss the factors at play and why, there's still quite a bit of information to gather. So right after the fact, near term, kind of immediate focus is what is going to happen to sanctioned Venezuelan barrels that are already on shore. what's going to happen to Venezuelan production with PDVSA going through kind of this entire process if you have instability within the country. And so for the storage side, one of the issues, and I guess it affects production very closely as well, but for the second half of December, the U.S. had a blockade of Venezuelan oil trade. So attempting to seize or intercept vessels going to or leaving Venezuela. And what effect did that have? So for the second half of December, Venezuelan production started to kind of gap lower by pretty significant chunks. And by the end of the month, we were down about 170,000 a day or more. And some evidence to say that those exports had fallen basically in half to about 450,000 a day. And so what that means is that Venezuela was building their onshore stores very quickly. They had to add to floating storage with tankers. And so the immediate question, going back to what we were discussing in the near term, is the barrels that are in storage, are those going to leave, and what happens to this blockade? And we got that answer by the end of the week. By really, Monday, Tuesday, we had the announcement from President Trump that they're going to do a transaction between 30 and 50 million barrels, somewhere between $2 and $3 billion of that trade. But really what that means is that it's lessening the pressure on Venezuela's production so that they free up their storage capacity. They can continue to produce about 950 to 1 million barrels a day. And it buys time for the U.S. administration to negotiate with the Venezuela's interim government and figure out what the next steps are. We do know that the blockade is still in place. We got our 5th vessel seizure this morning. We had some interesting, exciting kind of chases going on in there with the Bella 1 that transitioned to become the Russian-owned tanker, the Marinera. And so interesting stuff going on. And I think that's the near-term question. What happens to the blockade, and how does the U.S. kind of build that relationship with the interim government so that from 1 month from now, after we kind of get to the same point or same risks for Venezuelan storage, we have some kind of answer as to what is going to happen going forward. And so from there, that's kind of the nothing burger. The interim question, and maybe into the midterm or the long-term question, is what happens to Venezuelan production? And from your eyes, what are you watching to really give you cues into the timing of that and maybe repercussions for the global market?
Yeah, from my side, I think the market did get that right on the equity side when the markets opened. US producers were up and Canadian producers were down. What that was telling you is that there's a lot of expertise in the US to go help produce heavy oil. And I know there were people who were jumping up and down in California saying, hey, send us there. We can't produce here, but we can produce in Venezuela. And I think that is going to be one of the things in that intermediate term. Canadian crude is competing for Gulf Coast. I know you and I were talking. It's like it's disadvantaged. It's you have to send diluent up, and then you have to get the heavy crude down, while there's waterborne, and it's pretty easy to hit the Gulf Coast refining, which is built for heavy crude.
Right.
It could also be a displacement where if you can get enough in the intermediate term takeaway capacity from Canada, that could go to Asia and displace, like when crude was going to Asia, now go there and the Ven crude can come to the Gulf Coast, and that makes it all more efficient. So that's one way it could kind of connect in the intermediate term.
Yeah, I think the point on the advantage there, I think we should spend a little bit of time on that, because as we were talking about earlier today, what is the advantage for Venezuelan crude on the U.S. Gulf Coast? And a lot of that is coming from transportation costs, rough estimates. Obviously, this is going to change quite a bit, but rough estimates, it's about $3 a barrel to transport from Venezuela to the U.S. Gulf Coast. So that's from port to port, versus for Canada, the pipeline system, the tolls associated with that, it's going to be between $7 and $12 a barrel. So that is really the advantage that Mohit's mentioning right there. And also, I think for the Venezuela side, you can very easily transport that crude up to the U.S. Gulf Coast and transport on the way back, or on other tankers, kind of doing that diluent process along the way. So there's maybe some ease associated with the infrastructure side of that. The other side of what you mentioned that I think is also important to recognize is why does this matter on the broader geostrategic or geopolitical landscape? You hit on the Asia side of that. So who's the biggest loser associated with the U.S. intervention in Venezuela? And that is obviously going to be China outside of Venezuela. I think ultimately it's a good thing for Venezuela. Beyond that, China is the biggest loser. Why? About 5+% of China's crude imports are coming from Venezuela, perhaps more. A lot of it is routed through Malaysia and some of these other areas, so it's hard to gather. But it's the largest source of their heavy sour. For China to then lose that cheaper sanctioned supply, as you said, they're going to have to potentially go and negotiate, go into Canada and say, hey, can we get barrels to replace that? And really what that means for me is on a geostrategic kind of chessboard for the US, that is quite a bit of leverage in negotiations for trade between China and partners that we have significant trade with, but also relations are kind of still fluid at the moment between negotiating what the actual tariffs are going to be and things like that. Together, those two represent about $1.5 trillion in trade. So this move for the U.S. is solidifying a source of heavy sour crude. It's the largest deposits in the world, estimated 304 billion barrels. Again, that heavy sour that the U.S. Gulf Coast really likes. It is effective for kind of the changing mix of fuels for transportation. So gasoline is less needed, generally speaking, than diesel or the jets. And so all around, very positive move for the U.S. Gives a lot of leverage there. For China, definitely puts them in a weaker position to get heavy sour. That is globally the tightest supply. And when you think about 2026, 2027 potential action against Taiwan and any ammunition that the Western Hemisphere has to combat that, 75 to 80% of China's crude consumption depends on imports. So that is one of the major reasons to kind of have more influence over where those barrels are going or coming from. So all around, very, very interesting, I think, for the Venezuela-China discussion. And then the other one that you mentioned, middle of the week, I think the market really started to pay attention to the protests in Iran. And that's the other source of cheap barrels for China. Right. And, both of those together, I mean, that is a very strong move for the U.S. to be able to influence those two countries in any capacity. So, I think for the Iran side, we got back into this in June. It's kind of been on the landscape or kind of on the back burner for a little bit. For the market, that is, I think, way more relevant. You've got 3.2, 3.3 million barrels a day. The associated, I guess, concerns, the indirect concerns with Strait of Hormuz and the neighboring production, it's about 25 million barrels a day for both of those, ballpark. So about a quarter of the world's barrels are going through that one region right there. So it's way more sensitive. And I think you noticed that this week with the reaction to Venezuela versus the reaction to Iran.
Correct.
As we go forward, what's the thought that you have around Iran? Maybe we can game a couple of scenarios and say, okay, so if you have regime change or not regime change, what are the things that, people in the market should be thinking about?
Yeah, I think that's going to be very interesting because in the past, the U.S. has talked about, we are with you as in Iranian people, we are with you. But the current administration is actually willing to put some red lines there and say, hey, if you have peaceful protests and you attack them, then we will come after you. And that's sending a pretty strong signal. And in terms of what it can do, I mean, again, near term, it can be anything. But intermediate term, there's a lot of sanctioned Iranian barrels which can land. Mm-hmm. Potentially, say you have regime change, and there was a time when Iran and the U.S. had good relations. And if in some time frame it gets back to at least being neutral, then that production can actually be growing and hitting global markets. So it should be more supply, which will kind of hit global markets. So that's a good thing. Now, if you don't get that, if status quo stays where it is and they just kind of say, okay, we're not going to do anything, then I don't think it has as much of an impact. There might be some premium, but that's it.
Yeah. Yeah, and then
there's a third side. If you blow something up, then
right.
yes, that's supply gone.
Right. Yeah. That was the other one. Yeah. So if there is action on the other side, and something is rekindled between the U.S. and Iran and Israel, or anybody in the region, I think the developments between Saudi Arabia and the UAE, I think, are just kind of also not taking center stage, and nor should they, but also just a kind of another piece of information about the region. There's definitely some developments there that should not be ignored. And together, I think they are related. Syria, we have some more kinetic activity this week.
That was the Yemeni one, right? Where Saudis went in.
Yeah, Saudi, UAE, and Yemen, and then Syria versus the Kurdish forces. And yeah, so the new Syrian government versus the Kurdish forces in Aleppo. So there's just some stuff happening, and that potentially can have some effects on, say, Iraqi production. Obviously, Iran's going to be right in the middle of that, and potentially others in there as well. So,
and then, like you said, I mean, the straits are very critical.
Yeah,
so much of crude passes through there, and so if there is some kinetic or other action and escalation, then that's the choke point.
Yeah, and I think the bearish side of that, so the bullish side, obviously the geopolitical developments are going to be the main source of that. There's not really going to be at this point in time seemingly a structural shift in the next year for demand that we can really point as like a very supportive lever. When we look at the bearish side and the potential supply implications, as you mentioned, of sanctions relief, so the three parties that are potentially going to see sanctions relief in 2026, Venezuela, Iran, and Russia. So together you're looking at, just kind of back of the napkin math, roughly about 13 million barrels a day of production between those three. For floating storage right now, that's collectively about 40 to 45% of floating storage, kind of on the order of 40 to 50 million barrels or more. That supply, if you get sanctions relief, has to be something to consider. Obviously, when do those barrels come back to the market, or, as you've mentioned in the past, are they mystery barrels? Considering that potential with the duration of bearishness in the market, how long those shorts have been in the top quartile, and really that's been since fourth quarter of last year, top quartile. Yeah. So how do those two factors come into play for you? If there's no sanctions relief and you have shorts where they are now versus, sanctions relief, we can kind of go through the list.
Yeah, if there's no sanctions relief, my thought would be that the shorts would be running out of time, and then they would gradually mitigate that short because it's not paying them to hold it. If you do get sanction relief and you get the market gapping lower or moving down fast, they will be there to cover and say, okay, I got a gift and I'm gone. Either way, they need to cover. So if they get that moved lower, it just makes it more advantageous for them to cover. So that's one way to get to that.
Flush it. Yeah. So I think,
or you get something before that, you get something which, like,
catalyst.
You cross some things. Yeah. You cross some moving averages yesterday and today. And if Monday you get some continuation of that, you can get a very quick October-like move, another $3-4, and then you've got the late shorts flushed out, and then you reset.
Yeah. Kind of going back to the second half of last year, a lot of that bearishness was expected to have an impact on U.S. production. And I think the number that commonly gets thrown around is $60 or $65 for U.S. producers required to maintain production. And we've been in this kind of downward trend for a while now. We expected, or the market expected, to see U.S. production roll over sharply by kind of 3Q last year. Didn't see that. Saw it actually grow to 13.8 to 13.9 million barrels a day. And then towards the end of the year, we had it kind of come off a little bit, maybe 100,000 barrels a day from there. So 13.7, 13.8, still elevated. For the U.S. producer, how does the next 6 months matter based on, say, the hedge considerations that people had or the strategies that people had in the first half of last year. How long do we have until that really takes a toll on the U.S. producer?
I think it's interesting that you bring in the producer psychology here, because I know looking at last year, there were a lot of people who were very bullish this market. Then they got very bared up, with the April move, the tariffs and everything. And then gradually they believed that, oh yeah, we can't produce below 60, 65, so I'm not going to hedge. And then we've always seen that when prices go low enough, the leveraged ones get tapped on the shoulder and then they have to hedge. And then oftentimes they drive that last move lower.
Mm-hmm.
So it comes back to, from the producer community, it really is important to have your game plan, have your hedge plan, capital plan, and figure out with this forward curve, how do you achieve it? And then how do you optimize it as all these different variations go forward? So as you go forward 6 months, what's changed?
Mm-hmm.
And how do you optimize your book at that point? But not doing anything is not a strategy. And we always say hoping and praying is not a strategy. And that's exactly where it gets down to. So it becomes more important. I think when you're at 70 and 80, you can make a lot of mistakes in hedging and you're fine because the prices are really good. They bail you out. But once you're at these levels where discomfort sets in, I think it's very important to have a clear hedge strategy.
Yeah. And I think for the scenario that you mentioned, where you have the kind of wait and see perspective as we go lower, not taking action, we've laughed a little bit about some of these conditions sometimes where you don't take action and, it's a worsening scenario. But say this is the scenario that a producer is in last year. They decided not to hedge as heavily because of those expectations. When does it become problematic on a say you're hedging 18 to 24 months out in most cases? When is that really going to be taking a toll on the U.S. producer psychology from your eyes?
I think it starts getting really ugly when the market goes into a steeper contango. So for example, if any of the bearish scenarios play out, or even if they gradually play out, we've got a shallow contango right now. But suppose it starts getting deeper. You get a $4, $5, $6 contango between, say, the first few months and the 18th month or something like that. And they haven't hedged. Now the levels at the front are too low to hedge. You don't want to hedge where you're guaranteed to make no money. And again, then it becomes very important. What instruments, if you have to hedge, what instruments do you choose? And a lot of times producers have the feeling that I'm not going to hedge beyond 12 to 18 months because that's what I'm required to do. And again, sometimes the opportunities are outside of those 18 months. And when you wait for those 18 months to come forward, there may not be opportunity. So it really is a interesting way to look at it, is where should be the hedges? Are they in the front part of the curve? Are they in the back end of the curve? And the idea should be, okay, I need to get a certain amount of hedging done to get my cash flow, to get my revenues, to be able to keep the lights on.
Yeah.
No matter what price does.
Right.
But yeah, in terms of discomfort, I think the discomfort will be when, say, your back end stays at 55, 60 and the front end is hitting something with a 4 handle. I think there will be severe discomfort there.
And what are you really watching right now to give you cues into the real global S&D condition? So, we did not see as strong of builds as some were forecasting. We're now in a position where folks like the IEA are expecting a surplus of about 3.5, 4 million barrels a day. And EIA is expecting inventory builds between 2 and 2.5 million barrels a day for the first part of the year. Based on all of the geopolitical developments, one thing that I've recognized is that this forecasted surplus, it doesn't really seem like many people are subtracting the volumes that have been disrupted tangibly. And they are still saying, we are going to get a 2 to 4 million barrel surplus.
Right.
So, I'll leave it at that, and I have more thoughts maybe on that. But what are you watching right now, really, to give you directional cues?
I think the only thing in oil that you really can see is inventories on land. So looking at the levels, looking at the changes, are they stronger or weaker relative to what normally happens? And a lot of the non-build on land, like you mentioned earlier, has been showing up in floating storage. And then there's all the conspiracy theories like, wait, is that really there? Is it not there? It's like, those are estimates. We don't really know. So all that really gets known is when it hits land. And even some of those, when it hits land, how much is going into the equivalent of SPRs? US is disclosed, but not other countries. So it is oil is a very interesting market because from my perspective, there are more unknowns than there are known. But in terms of S&D, that's really all you have to go with is inventories. Yeah. And the curve shape, I mean, the other thing to look at is curve shape. A lot of times that tells you how cheap or not cheap the physical barrel is. So that front spread and the cash where it's trading relative to the front, that's really another indicator to watch because that's two ways to look at it. Okay. Like say Brent, I mean, dated versus first line. That's telling you a little bit about whether there's a need for that prompt barrel or not. US, you see M1, M2. Okay. If it's not wide enough, no storage operator is going to use that to put into storage because it's not paying you enough. So again, those are signals which I do look at in addition to inventories.
Yeah. And when you have 1 and 2 of about, a dime, what's consequence?
It's not telling you much.
Yeah. Yeah, no, but I think going to the supply overhang or the expectations for the supply overhang, I think the level of bearishness to some of the actual, whether they're accurate or not, there's definitely some debate, but those signals have been largely underwhelming versus the bearish expectations. So not as bad as you might expect them to be if you're reading some of the coverage out there. But they're not great either. And so there's definitely a signal that is, okay, there's caution, it warrants caution, but it's not as bad as they're expecting. And I think when we look at the forecasted overhang for the first half of the year, let's just use EIA numbers, inventory builds of 2.5 million barrels a day. So let's say that's our overhang. In December, you lose 800,000 a day of exports from Kazakhstan. It's beginning to force production curtailments. There's not really a strong word on when CPC, the Caspian Pipeline Consortium, is bringing back the damaged mooring that they are now trying to replace with one that was offline already for maintenance. So impacts there to Kazakh production, let's just say, 500,000 a day for the near term. Production impacts to Russia, most likely looking at somewhere between 100 and 200,000 barrels a day just from attacks in Caspian Sea. You have basically 450,000 a day for the second half of December for Venezuela. Most likely see some of that come back pretty quickly. When we look at U.S. production rolling off about 200,000 a day, and from there, I guess you get pretty close to half of that forecasted surplus. Is there any more that you can kind of pull on that to say we might be closer to balanced at this point?
There's actually a different angle also, which I look at, and I know you and I talked about this earlier. U.S. products were very, very low. They have been building very rapidly,
fast.
Particularly gasoline. And from my perspective, again, just looking at different factors, that's one support which has weakened. So, okay, you're not getting the oil build. That could be because you're refining it and now you're getting product build. And at the end of the day, the total of both those matters. So you see that in the cracks. I mean, we were at like almost $55, 52, $53, and now we are much lower.
Yeah, 32, 33.
Yeah.
No, I think it's. Go ahead.
I think that's another signal which tells me there's that support under crude, which is eroding.
Yeah, no, I think it's an interesting way to start the year for sure. I'll be very interested to see how the next few weeks unfolds, and I think the final one, the Russia-Ukraine situation. When we discuss that, we're looking for cues on the territorial concessions. If there is that type of deal that's being made that's resolving the Ukrainian concerns, Russian concerns over the territories that one or the other would have to give up within Ukraine. That seems to be the main hurdle at the moment.
Right.
And if we get that resolved, what else should should we be thinking about? Because you have obviously floating barrels, talked about that. You have, the vessels are going to be, vessel capacity will be opening up. What else? What else is remaining?
I mean, you could also have, again, not near term, but intermediate term. I mean, let's say peace breaks out in Europe. A lot of the US operators were in Russia and they exited when the sanctions got placed on them. So just like when we're saying US operators can go back, Chevron's already there in Venezuela, but others can go back. Exxon was in Russia. Other operators were there. So it opens up more production in the intermediate to long term.
Yeah. So definitely going to be some answers or some questions to answer for the bulls. And yeah, just kind of looking ahead, I think the signs will definitely be coming from, US and more of the expensive producing areas. So yeah, we'll be watching those.
Yeah, and the last thing I'll leave with is, given that shorts are still very, very high, if you go into 1Q and say early 2Q and you're not getting that build, which people are expecting, the way they penciled it was there's going to be excess barrels in the first half, and then by second half, it's going to clean up. So now you go to the first half and it's not happening, and now you're thinking that there will be draws. That could be very supportive for the market.
It'd be very interesting. Yeah.
Plenty of, I think the one thing which you're going to have is volatility. Headline driven, action, inaction, all kinds of news.
Yeah.
And algos will be going crazy.
Yeah, definitely no shortage of headlines to start the year. So if this is the rate that we should expect, I'm going to have to recalibrate some of the ways that I read the news. That's for sure. Awesome. Well, I think that's a great way to start it off for 2026. We'll be back to obviously discuss whatever happens next between all of the different arenas that we have going right now.
Sounds great.
Awesome. All right. I'll see you next time.
Thanks for joining us on the Energy Desk. Please keep in mind this commentary contains our views and opinions and is based on information from sources we believe are reliable. This commentary is for informational purposes, should not be considered investment advice, and is not intended as an offer or solicitation with respect to the purchase and sale of commodity interests, or to serve as the basis for one to decide to execute derivatives or other transactions. This commentary is not considered promotional material.